America added jobs. Markets breathed a sigh of relief. But beneath that headline, warning signals are flashing inside the world's biggest economy. If the United States slows, global markets, from Wall Street to Mumbai, feel the impact. Tonight, we break down what the numbers really say. Let's start with the headline. The U.S. economy added 115,000 jobs in April. That sounds reassuring. Especially after February's sharp decline of -156,000 jobs, followed by a rebound of 185,000 in March. But volatility like this raises an important question: is hiring stabilizing, or simply becoming unpredictable? Now look deeper. The unemployment rate held steady at 4.3%. At first glance, that suggests stability. But labor force participation slipped to 61.8%, while the employment-to-population ratio stood at 59.1%. Nearly 4.9 million Americans were working part-time for economic reasons. That means many workers may want full-time jobs but can't find them. Not all sectors are struggling. Healthcare added 37,000 jobs. Transportation gained 30,000. Retail added 22,000, and social assistance rose by 17,000. These are sectors tied to everyday economic activity, suggesting consumer demand has not disappeared. But that's only part of the story. Now the warning signs. Information sector jobs fell by 13,000. Financial activities declined by 11,000. Federal government payrolls dropped by 9,000. These are sectors investors watch closely, because weakness here can often signal broader economic cooling before it becomes obvious. And the labor market is not affecting everyone equally. White unemployment stood at 3.7%. Black unemployment remained much higher at 7.3%. Asian unemployment was 3.3%, while Hispanic unemployment came in at 5%. The headline may look stable, but the pressure is clearly uneven. This is where the Federal Reserve comes into focus. Wage growth remains elevated, meaning inflation pressure may not disappear quickly. That complicates interest rate decisions. If the labor market stays resilient, the Fed may hesitate to cut rates. If weakness spreads, markets may start pricing in a slowdown. Why should global viewers care? Because the U.S. economy is still the world's demand engine. A slowdown can hit Indian IT exports, European manufacturing, commodity demand, shipping, oil markets, and emerging market currencies. What happens in the American labor market rarely stays in America. For investors, this is where things get interesting. Is this a soft landing where growth slows but avoids recession? Or is this the early warning stage before deeper weakness appears? Smart money will now watch wage growth, inflation, bond yields, and the Fed's next signals. So what's the real takeaway? America added jobs, but the bigger story is hidden beneath the surface. Stable unemployment, weaker participation, rising part-time pressure, and sector-level cracks create a more complicated picture than the headlines suggest. Stay informed, stay sharp, and if you want more global finance and strategic analysis, follow Golden Rules.